Okay, now I want to use a fun little example to show you that this two numbers approach to creating assumptions in the forecast. In this case, we're going to do it. I'm going to take a real live example, Chuy's Holdings Inc., which is a restaurant chain, cool little restaurant chain. Well, maybe not so little anymore. We're going to use them as an example to look at how we could forecast their revenues. We don't know anything much about them except for some of the public information that's out there because it's a public company. So I want to demonstrate for you how we do this big picture, top-down approach to the two numbers assumptions to drive our forecast numbers. So Chuy's was born in Austin, Texas, right here where I am, in 1982. Went public in July of 2012. At the time they went public, they had 32 restaurants. Now they have 80 restaurants in 16 states. That was as of December of 2016. Revenues of $331 million, well on their way to $400 million, because they've been opening about 12 to 14 new restaurants every year. The average revenue per location is about $4.6 million. So in the scheme of things, I call this a large company, right? Especially in the scheme versus a small business. So large company, big revenues, big P&L, big balance sheet, big cash flow. What we're going to do as just an example here is we're going to say, what do we need to do in order to implement this two numbers approach to creating the revenue forecast? So what you got to do is think about what are all the different things that go into revenues in a restaurant chain like this. So there's number of customers, there's the average ticket, how much each person basically spends on average when they're there. The size of the restaurant surely matters to how much revenues they would generate in any given period. The restaurant location is in a good part of town, a not so good part of town, big city, small city. What are the same store sales results? What have they been? What are the trends? I'll show you that here in just a minute. That's a very, very important metric in most restaurant businesses and retail chains. How much in sales do the new restaurants do, and when do they get open? There's a whole lot of factors there that if you're saying, Philip, you're asking me to forecast or quote predict revenues in a company that's this big with all these different variables. Yes, and I'm going to show you how, but what I want you to see though is look at all the different things you could consider. Number of tables, table size. Do they have a takeout option or not? Do they have a delivery option or not? Do they sell a lot of liquor versus food sales? Because when I go to a Mexican restaurant, I'm probably spending more in margaritas than I am for the food. In fact, that probably happens almost every time I'm in a Mexican restaurant. So there's all these different things that this is where the devil jumps on your shoulder and says, Philip, I can't use just two numbers to forecast revenue. Look at all the different things that are involved here. There's no way I could, quote, predict these things. So here's what I did. I took their financial information and I set it up in the forecasting format. You're going to see a similar format when I talk about the ABC construction company here in just a little bit. But I set it up and I just said, just with respect to revenues, because we're not beginning with a clean slate to do our forecast, we're starting with actual result. And so I dropped those in there for revenues, and I dropped some of the key results in there, some of the key metrics. So I looked at, and what we're going to use for purposes of this little exercise, and what I've done in creating this model, is we're going to look at the store count at the end of a period. In this case, it's quarterly because they're a public company and they file their financial results quarterly. We're going to look at what's their store count at the end of the quarter and what's the average revenue at the end of the quarter, because those are the two numbers that we're going to use to forecast revenues for this large 80-plus chain restaurant that's doing, pushing close to $350+ million in revenue. Those are our two numbers. Store count at the end of the quarter times average revenue is going to equal our forecast revenue. So the first thing we do is look and see what has been going on with respect to those metrics or those drivers. So at the end of December 2015, they had 69 stores. The average revenue per store for that period was $1,028,000. That's just math. That's just, so they had 69 stores open. That's in their the information that they disclose as a public company. And then I just computed, I took the revenues of $70,961,000 over 69 to get the average revenue per store. And I did that for each quarter. So you can see In the March 2016 quarter, they added 2 stores, and the average went up some. Then in the June quarter of 16, they added 4 stores. Then in the September quarter, they added 2. They've been on a pace to do, 12, 13, 14 or so every year. So that's, something roughly in the 3 to 4 stores, anywhere from 2 to 4 stores a quarter. And then in this far right column over here, I just dropped in some information that's useful information in a restaurant chain or really any a retail location. That's same store sales. A same store or a comparable store is one that's been open, in this case generally around 18 months, so that in the quarter in which they're looking at their revenue performance, how does that quarter relate to for that store for the same quarter in the prior year? Basically, it's a measure of how healthy are the existing stores. And especially in a company where there's a lot of growth going on, where they're adding a lot of restaurants, one of the questions that investors are interested in, and management and shareholders are interested in, is, are these new stores cannibalizing the old stores? So that's one of many reasons why this metric is so important. And you'll notice up here that it was pretty strong at about 3.2%, 3.2%, 1%. So the store performance was coming down, the same store performance, comparable store performance, down to 0.3. And then in the December 2016 quarter, down 1.1%. So and I can tell you this is a concern for this company. The stock price has been dropping because of this performance, because investors are trying to figure out why are their store sales, comparable store sales like that dropping, because that's a sign that maybe some of these new stores that they're adding every year, the 12 to 14 they're adding, might be causing some problems with their existing stores. But so as we look at this, right here, we've got everything we need to make a pretty good high-level, top-down, 2 numbers based assumption for what we think revenues might be for the quarter ended March of 2017. And the 2 numbers that we drop in here are how many stores or restaurants do we think will be open at the end of March 2017, and what do we think the average revenue per store will be. So we know they've been opening 2 to 4 a quarter, so and it's usually closer to 2. So that's really a pretty easy assumption to make. It's not going to be right. It's not going to be perfect by any means. But this is a good exercise to show that when we don't start with a clean slate, we start with existing information, we force ourselves in this 2-number approach, then even with a company that we don't know that much about, because you know a whole lot more about what's going on in your company than we know about what's going on in this one. And then, so we make that assumption, we drop that number in there, and then we say, how much do we think the average revenue per store will be? We know the comparable store results have been down, and remember, that's down relative to the same quarter of the prior period. So if that was the case, we would expect that results would be down from this $1,099,000 average per store, because these numbers are stated in thousands, these dollar amounts are. It's not from the prior quarter, because December is a seasonally weak period for them. Okay, so in the next slide, I'm going to show you what it actually turns out to be. Voila! They actually ended up with 82 stores. Well, you'd be hard to miss that one by a whole lot, because you're either going to put 82, 83, 84, something like that in there. And in this case, their results did indeed drop a little bit from the same period in the prior year, down in this case to $1,060,000, for revenues about $87 million. So the point is, and the reason why I like this example so much, and I model this particular company, I look at it every quarter, I make my own assumptions about the forecast, and then when the results come in, I take a look at it. Just because it's a fun process, such a great way to help someone in a company that says, how can I take my company, much less some large company, and really distill things down to this quick start approach. But this is a good example of how 2 numbers get you your revenue forecast. And in this case, even when I put this together before I knew what the March quarter looked like, I was very close. And I've done this with a number of different people, and everybody comes out very close to these same numbers.